Okay, you're very welcome to this brief tutorial. My name is Stephen Cox. I'm the Managing Director of Share Navigator. And just on your screen, before we get into why diversification works, why not register for a free stock market training class? You can register online and you can log in from the comfort of your own home. So no matter where you are in the world, we'd be delighted to have you online at www.sharenavigator.com. Okay, what we're going to discuss today is why diversification works in the stock market. And really, diversification is a strategy designed to reduce risk by spreading the portfolio across many shares. An awful lot of retail investors have heard this over and over again. Don't put all your eggs into one basket, but they continue to do so. So really what we're trying to do here is shed some light as to why you should reduce your risk by diversifying across many different asset classes. And really diversification works because prices of shares do not move exactly together. We're going to talk a little bit about correlation in the next slide and how that works. And diversification works best when stocks are negatively correlated. What does that mean? Well, typically if one share price goes up, the other will actually go down. And that's when diversification works best. And again, we're going to show you why that is so. And just a little disclaimer here, folks. Diversification does not eliminate all risk in the stock market. You can't do that. If you want to make money in the stock market, you have to take a certain level of risk on board. Okay, so just be aware of that. So correlation, what is it? Well, correlation is really the relationship between 2 companies, 3 companies, 4 companies that you may have in your portfolio. And how do they actually move for a given move in stock price as such? So, for example, a perfect example of a negative correlation is oil prices and airline companies. Obviously, if oil prices are going up, it's making it more expensive for airline companies to fly their planes all around the world. So, airline stocks tend to go down when oil prices go up. And that's why you should be looking at, if you are invested into airline stocks, what is their strategy for hedging the risks to oil price increases as well. So you've got to be aware of that. If you follow Ryanair and Aer Lingus, etc. like that, you would have seen that over the last 2 years. 1 year Ryanair did very well, they hedged very, very well, and then they got it wrong another time and it caused the share price to fall. So that's a perfect example of negative correlation. An example of positive correlation is when 2 stocks tend to move closely together. So, for example, if AIB goes up by 2%, and roughly Bank of Ireland will go up by something similar. So, shares that are positively correlated tend to move in tandem together. And unfortunately, an awful lot of investors in Ireland, their idea of diversification in the last 5 to 10 years was AIB, Bank of Ireland, and Anglo. And they all moved in tandem, as you can see. So, just before we go on, can you think in your own mind of a negative correlation within the same industry? And, Walmart, folks, which is a discount retailer in the US, their share price went up by 33% during the recent crash in the market. So when the market sold off heavily, Walmart went up. Why? Because they're very much like Aldi and Lidl in Ireland. So something where we weren't shopping many years ago, or we wouldn't admit it, we're now happy to admit and proud to admit we all shop at Aldi and Lidl these days. So in times of recession, the consumer obviously looks to save money and they'll shop in discount stores. And that's why sometimes there's negative correlation within the same industry. So while Walmart went up, if you looked at Tiffany, the jewelry retailer, their share price fell heavily as well. So that's negative correlation in the same industry. So that begs the question, why does diversification work? Here's a very quick chart. This is market risk here on the left-hand side. And on the bottom here, what you have is number of stocks that would be in your portfolio. And we have a thing, the red line here is called the market risk. The market risk, folks, is macroeconomic risk. This is risk you cannot get rid of. If, for example, the US economy starts taking a dive, the stock markets will sell off. And you can't diversify that risk away. You can with derivatives, but just for total stock investing, you can't diversify that risk. The blue line represents your portfolio, And at the top here, when your risk is highest, you're only invested into one stock. But as you invest into more stocks, you can see your risk eventually declines. And you can almost reduce your risk to what we call the market risk by investing in between 10 to 15 stocks. So you should have between 10 to 15 stocks in your portfolio, folks. If you don't, you do have what they call unique risk attached to your portfolio. So what is unique risk? Well, let's think about it. A favorite company in Ireland was Elan, and over the last 5 or 6 years we've been treated to a roller coaster ride. Same with the banks, etc. like that. So their risks unique to the company. And if the company has bad earnings results, for example, the share price will more than likely sell off, and that's a unique risk associated with that company. But the more securities or stocks you have in your portfolio, it's highly unlikely that they're all going to have bad results at the same time, or they're all going to give out bad news at the same time. So while one stock may go down, the other stock may go up, and it tends to balance itself out. Okay? So that's a little bit about market risk and unique risk. You need to know that, folks, if you're investing in the stock market. This is why you should diversify. We took the worst possible time you could invest in the stock market, the top of the market in 2007. So we said, right, if you had made the worst decision of your life, you invested your money in 2007, and this was to the absolute bottom of the market. So this is your worst investment period ever, folks, right? And we created 4 different portfolios. If you invested into Bank of Ireland only in Portfolio 1, you would have lost 92.5% of your investment. Portfolio 2, we put Ryanair in there. And although Ryanair also went down 44% almost, your total portfolio only went down by 68% in this case. In Portfolio 3, we added in Paddy Powers. And Paddy Powers actually did very well during this period. Their share price went up by 31%. So by adding in Paddy Power into the mix, your total portfolio only went down by 35%. I know it's not exactly the numbers you want to be looking at, but it's a hell of a lot better than nearly 100% of your money being lost. Now let's get into Portfolio 4. We added in Kerry Group, we added in Apple, we added in Google, and we added in the Gold Exchange Traded Fund. If you had have invested into that basket of shares, folks, your portfolio would be up 7.5%. So by diversifying, you reduced your unique risk down in the market. You went from a loss of 92.5% to an absolute profit. So the market actually fell, folks, and you managed to turn it around into a profit. That's why diversification works. Okay? Now, that begs the question. Unfortunately, not everybody has enough money to be able to invest into 10 to 15 stocks. We fully appreciate that. So what can you do? We think exchange-traded funds, folks, are the place where the total beginner should start investing their money in the stock market. Why? Because they're diversified funds. They're set up specifically to track maybe a stock market index or a particular sector in the stock market. You can even invest and track the gold price or silver prices or the increase in bond yields, for example. You can even buy an exchange-traded fund that goes up when the stock markets go down. And it's diversified across a number of different assets to replicate a specific move in an industry. So you're automatically, in most of the exchange-traded funds, diversified to the unique risk of the market, and now you're just playing a directional trend. And this is a very good vehicle, folks, to use when you're rotating in and out of different sectors, because as we highlighted to you earlier, Walmart went up and the stock market fell. So some sectors actually perform very well when the stock markets fall. And what you've got to do is start thinking like an institution does. So an institution will start rotating its funds around different sectors at different stages of the economic cycle. And sometimes they actually rotate out of the stock market altogether and into the bond markets. You've got to start learning about that, and that's why we're here. We're here to help you. Okay? We think if you never do business with Share Navigator, start learning about exchange-traded funds. If you're a total beginner, it will give you diversification in your portfolio. If you would like more information and help, please contact us. You can attend a free session with us online, and we'd be delighted to help you. Thanks and bye for now.